The latest round of 13F filings in the U.S. shows a wide difference in how hedge funds and money managers have been positioning in the equity markets. We're going to Jacksonville, Florida for the details. Joining us via Skype is Ross Givens. He's Chief Market Analyst at the investment advisory service Wealth Empire and 13F Insider. Ross, as we always like to remind our viewers what a 13F filing is. What is it?
Sure. Well, a 13F, and thanks for having me on. You know, the Securities and Exchange Commission requires any fund manager who manages $100 million or more and does business in the United States to file a Form 13F once per quarter, including all of their long equity positions.
So it shows, and it is, I always like to remind people, it is a point in time. So at the end of September, in this case, we look at the portfolios and see how they differed from a point in time at the end of June. So we're a month and a half in, so things could change, but it's always interesting to see the dynamics. You've noticed a difference between money managers, kind of the traditional guys, and hedge funds over the course of the quarter. What are you seeing?
That's correct. Yes. So, you know, there's really what I consider two levels of smart money, right? I mean, people think if they call it smart money and that being institutional dollars, but then I think there's smart money when you look at the hedge fund managers that have multi-decade track records of market-beating performance. So when we're talking about the best of the best, this is one quarter I find it kind of alarming. So to give you an example, when we look at all public fund managers, the areas they bought the most over the last quarter were biotechnology, consumer packaged goods, and REITs, real estate investment trusts. And the areas they got out of the most, online media, oil and gas exploration companies, not a big surprise there, and industrial products. But when we look at those top hedge fund managers, they're actually buying some of the things that these guys are selling and selling some of the things that are buying. So for instance, they're buying integrated oil and gas right now as an opportunity. They are buying industrial products right now. On the other side, they are getting out of REITs. They're dumping real estate, they're dumping building materials, and they're dumping biotech, I would assume, because they see it as the run has already happened. So kind of interesting. It really looks like the general money managers are sort of late to the party, and hedge funds have already kind of had their fun. They're moving on. It
sounds to me, too, that the money manager, the kind of the run-of-the-mill guys, maybe a bit more defensive, notwithstanding biotech, and the hedge funds are more aggressive. Is that kind of fair?
No, I think that's a very fair comparison overall. I mean, you know, I think to even take it a level further is these kind of run-of-the-mill money managers tend to be kind of chasing what's moving. So they're buying into biotechnology since it's going up. They're buying into REITs from a very basic standpoint because they're scared. They want some kind of a yield. Meanwhile, hedge funds have kind of seen the writing on the wall and moved the other way.
Now, there's not often a lot, well, there are, I mean, U.S. and also Canadian managers who operate in the U.S. have to file these filings as well. But we do see some interesting Canadian names. One stood out to me right away. The most purchased stock, Alamos Gold, that kind of just jumped out amongst them. What's happening there?
Right, yeah, Alamos Gold is the #5 most purchased stock by, again, all institutional money managers over the last quarter. So I think what's happening is people are beginning to position themselves into gold. You know, we look at the long-term trends in precious metals. You probably would agree that we can't predict what gold's going to do next week or next quarter. But when you're buying those metals at or near the all-in sustaining cost, or what it costs these miners to get it out of the ground, it tends to be a pretty good strategy over the long term. And so I think some people are beginning to get in. You know, these mining companies are trading, the majority of them are trading at 80 or 90% of book value, and that's the opportunity we haven't had in over a decade. And so, you know, are they going to perform in 2016? I don't know, but I bet if you hold it 4 or 5 years, you're going to have a pretty good return from those stocks.
On the other hand, also the most purchased stocks by the hedge fund managers, some defensive names do show up. J&J, Apple, Capital, although Capital One was weak in the quarter, the hedge fund managers were buying.
Right, and I've noticed notice that, you'll generally find, these hedge fund managers, the guys that again, have averaged 20, 30% a year for decades, are just the best of the best. They invest very differently than the average investor. I mean, they're buying when stocks come down because they realize they're getting more earnings and more value for their dollar, and they're selling on the way up as their profits are realized. So, COF, Capital One Financing, one of the top buys of the top hedge fund managers, and that's a stock that it fell from 91 to somewhere around 71 during the last quarter. Now trades at 10.5 times earnings. It trades at under book value. I think they're seeing the opportunity there. But you are 100% right. It's kind of interesting. You mentioned hedge funds being more aggressive. The stocks they're buying are really staples. And here's how I view that. I hate to get too complicated with it, but they tend to go after higher margin companies toward the end of a bull market, and that's why they're buying into Johnson & Johnson and AT&T and Apple and HPQ as well.
Are we at the end of the bull market, Ross, just before we let you go?
I think we've got another year to 2 years left, but I'd say we're probably in the middle of the seventh inning, late seventh inning of a bull market.
Ross, thank you very much for joining us.
My pleasure.
Have a good week.